Hey everybody, this is Dan Sheridan, and I'm going to start a little bit of a double series. And there'll be four strategies: a double diagonal, double long diagonal, double calendar, and an iron condor. And there's four strategies, and I'm going to talk in the context generally doing these about maybe 2 to 11 days from expiration. And all these doubles, what's a double? It's something that is linked by one thing. The shorts are very similar. You're selling an out of the money call and an out of the money put. All of these four strategies have that in common. And you might think, well, why did he say like 2 to 11 days? Well, when you're short term like that, price risk, when you're close to expiration, price risk becomes a big deal if it moves against you. So by doing a double, selling an out of the money call and put, gives you more room. So let's start with the first double that I'm going to cover. And basically in these series, what I'm going to go by is the same template, kind of review what are the doubles, the differences with the doubles so you get used to it. A little bit of teaching on what is this double diagonal and why should it be part of your life, right? Then I'm going to go through a test in options omega, make sure the thing works. It's a reasonable strategy. And then I'll show you, I'll have it automated live and we'll keep up with those. All right, so first of all, what is a doubles? How can you understand it? And I'm going to just put here for a second, August 22, just use this for an example, and August 26th. And today is August 11th, so it's a Monday. This example, I'm in the kind of the longer duration of this. I'm going to be selling 11 days from expiration, buying 15 days. So this would be an example. I'm going to sell one 64, sell one 64.70 call, and I'm going to sell one 63.20 put. Hey, Dan, what's SPX trading at? SPX is around 63.88. So I'm selling a 64.70 call out of the money by about 80 points. And I'm selling a 63.20 put out of the money, 60, 70 points. That's a short strangle, selling out of the money call and put. So we've got room. As long as we're between our shorts at expiration, 64.70 and 63.20, boom, we do well. Now, look where I'm going to buy my longs. I'm going to buy my longs further out of the money by 164.80 call. So I'm going to buy my longs 10 points further out of the money. So I'm going to be buying less extrinsic value than if I bought my long at the same strike, 64.70. That would be a calendar. But I'm going to be buying less extrinsic value, that part of an option that decays. So I'm going to be buying less volatility risk. I'm going to buy the 64.80s, and then I'm going to buy one 63.10 put. This is a double diagonal. Out of the double diagonal, double calendar, double long diagonal, this would be the least volatility risk. If we go down, I'm buying the least amount of extrinsic value. So you can see that's the setup. And there's different, you can put different days between them here. I'm selling in Aug 22, 11 days out, buying in Aug 26, 15 days out. Dan, what do people like about these double diagonals? Well, you have a lot of room between the shorts, so the probabilities are in your favor. And you'll see in this test that I'm doing, I'm selling a 25 delta put and a 20 delta call. So we got some width there. So the market's got to move quite a bit for us to lose there. And again, I'm buying my protection or hedges, the 64.80 call versus the 64.70 calls, and the 63.10 puts versus the 63.20. Those are my hedges. And, if I bought my longs in the same expiration, but further out of the money, that would be an iron condor. And if I bought my longs at the same strike of the shorts, that would be called a double calendar. And I'll stay away from the double long diagonal for a second. But But you could see, so the first question might be, well, Dan, when would I do one versus the other? The double strategies are generally, I would love to do them when the VIX is maybe in the lower end of the range. And I'm talking in 2025, so lower end could be 15, 16, 17. And you'd love if the volatility rose, right? It's a long vega. It's a mixed month trade. So we call it a double diagonal. Diagonal, the term diagonal just means mixed month spreads, and you're doing different strikes, right? A calendar is mixed month trade where you're doing similar strikes. So double diagonal, I'm buying the 64.80, selling the 64.70. That's a diagonal in the calls. The puts, I'm buying the 63.10, selling the 63.20. Those are diagonals, right? Call diagonal and put diagonal. Why is it a diagonal? Different strikes. If it was a calendar, I'd buy the 63.20 put, sell the 63.20 put, buy the 64.80 call, sell the call. If it was an iron condor, my longs would be in the same expiration. So here I'd be buying the 63.10 puts, here I'd be buying 64.80. And a lot of it's volatility. The higher the volatility, when you're thinking reversion to the mean going down, I'd like to do iron condors. Volatility is low and I'm expecting it to go up, one of these double strategies. So you can trade low volatility and high volatility environment. But the attractiveness of the doubles in general is you got a lot of room. It's positive theta, number one. You got a lot of room, number two, so you get the probabilities in your favor. And we're generally selling these options somewhere, not that you can't do multiple different durations, but I'm focusing more on maybe from 1 to 2 days on the short end to 10, 11 type days on the far end. And that's this example. So that's just mechanically what it looks like. You can kind of touch and feel it. A couple examples of that would be, here's one example today that I was looking at for a trade. In this example, again, this is an 11-day. This is very similar to what I showed you. This is kind of how we set it up, or how I look at it on a Monday. On a Monday, this would be an 11-day double diagonal. This is typical what we would do. Here's the underline at 63.90. So this would be an 11-day double diagonal. I'm selling a 64.70 call and a 63.20 put. What is that called? It's called a double diagonal. It's called a short strangle. Sell me out of the money call and put. Now, in this example, I sold the calls a little bit higher. The 64.70 calls is near a 29 delta, and the puts, the 63.20 puts, if I scroll down here, about a 30 delta. So this is about a 30 delta double diagonal. What does that mean? I'm selling on a Monday, 11 days out, about a 30 delta call and put. And then I'm going to buy my wings, or I'm going to buy the expiration 4 days further out. And I'm going to buy the call 10 points further out of the money on the call side. Here's your short put. I'm going to buy my long put 10 points further out of the money on the put side. Now, this is an example of a 30 delta double diagonal. Now you might say to yourself, well, first, for two things I want to show you. One, how do you come up with the pricing on these? Number one, and let's talk about different deltas. So pricing, the way you price these a double diagonal, unlike a calendar, your debit is your risk. Your debit is what you pay. Here, you just simply take the difference in the strikes and the calls, 64.80 to 64.70 is 10. The put side's 10 also, 63.10 to 63.20. So you have $1,000 plus your debit, almost $5. So in a double diagonal, so this would be about $1,500. That would be the risk in this. So in a calendar, is your debit your risk or your margin? Or when I say margin, when you go in to do a trade, your buying power will decrease by that amount. But in a double diagonal, you take the difference in the strikes, 10. If it was 500. If it's 10, 1,000 plus 5 is about 1,500. So that's pricing. This is a $1,500 trade, but the debit is about $5. Next thing, deltas. I look at this and say, okay, Dan, you did it. The short call is 30 delta. The short put is 30 delta. Dan, the volatilities VIX are pretty cheap, 15. What if you want more room, Dan? What if I'm willing to give up because I think this volatility is pretty, 15's cheap for 2025. I'm confident, or, I'm comfortable with that number. I'd give up a little bit in the middle, Dan. And if I'm willing to give up a little bit in the middle to get my short strikes a little bit further out, how can I do that? Well, instead of a 30 delta, I would sell a 20 delta or a 25 delta. Go a little bit lower delta. What if I said, hey, Dan, you know what? There's some events coming up this week. You've got CPI, PPI, DUI, whatever I coming up, right? And you say, hey, you know what? I want to get a little more theta. I want to get out of the trade quicker. How could I raise this here, bring my shorts in a little bit, get more theta, maybe get out of Dodge a little quicker? How could I do that? Instead of selling a 30 delta call and put, maybe a 35 delta call or a 40 delta call. What I like about if you can sell a 25 delta put, 20 delta call, it's going to lean a little bit long delta because the market generally goes up over time. And you'd like to be a little bit long delta because the market goes up, SPX does what? It goes down, right? So you could lose a little bit on that. So I'd rather, especially if we go up, which we go up a lot of the time, I'd rather lean a little bit long delta, and I have the put at 25 and the call at 20. We'll go over that. But this is just a little rundown. You say, Dan, why do you really like double diagonals? It's the most flexible of the double strategies. Dan, what do you mean by, like, why do you think it's more flexible versus the double calendar or double long diagonal or even an iron condor? Because, well, I can do it in a lower volatility, but I'm more comfortable doing this in the middle of the range. For example, if VIX is the lower end of the range for 2025, the VIX is in the 15s. Well, what if the VIX is 20 or 21 and then it comes down? From a volatility viewpoint, am I safer in a double calendar, double diagonal, or double long diagonal? Double diagonal. It's a little more flexible. Per dollar, you have less volatility risk than a double calendar or a double long diagonal. Now, it works the other way. If the market goes down and volatility goes up, double calendar and a double long diagonal have a little more bang for the buck. They would do better on that. The double calendar is going to be your cheapest double calendar. It's the most, like they say, pound for pound, the best boxer in the world. A double calendar, probably pound for pound. I like it the best, but the double diagonal, especially upward trending markets, has less bite to it than some of the other doubles like double calendar when the volatility goes down. And then here's an example of, now today's Monday, here's a 5-7 that I put on Friday. Today is a Monday. Dan, what does that mean, a 5-7? 5-7 would mean if we're on Friday, what's 5 days from Friday? Saturday, Sunday, Monday, Tuesday, Wednesday. So you're going to, on Friday, if I do a 5-7, you're going to sell Wednesday. So on the expiration of Wednesday, which would be August 13, I'm going to sell an out of the money call and an out of the money put. Get about a 20 delta in the call, 25 delta in the put. And then, so that's 5 days away. Now on Friday, I'm going to buy 7 days away. Saturday, Sunday, Monday, Tuesday, Wednesday, through Friday. So I'm going to buy Friday, sell Wednesday, right? And you can see from Friday to Monday, VIX is up a little bit today. So you can see in this trade, I paid $8.45. And this was an automated trade on option Omega on Friday. And you can see it's trading right now, 8:45. This is a Monday, about $10.10. So what kind of money is that? $8 and $8.45, right? $8.45. And now it's around $10.10. What does that mean? Well, what did this trade cost, right? If you went in to do this trade, they're going to allot X amount of money for this thing. How much? Difference in strikes is $10,000 plus your debit. So this is about $1,845. So on $1,845 of capital, we're up 845, 945, $1.55, $1.65. So you're up about $165 on capital of 1845. That's about almost 9% in one day. 165. Dan, is that unusual? No. Why is it? Why isn't it unusual? It's a short-term trade. Short-term trades have more positive theta, right? So that's not, that's positive theoretical theta for one day. So you have the positive theta. So it's not unusual, as Tom Jones would say, but you have why people like these is because in a short-term trade, you have more price risk if the market moves against you. So here you can see your short options are pretty far out of the money. 64.55 on the call side, 63.35 on the put side. And we're currently at about 63.90. So we've got a good 60 points or so to the short strike on both sides, which is decent, right? You say, Dan, why do you say it's decent, right? Well, if I looked at how long do I expect to, let's say you were going to be in it, even to this Friday. You could hold it till expiration, a lot of different ways you can handle this. But just to give you an example, this thing expires Wednesday, August 13th. Game over. What's the expected move to Wednesday? If we held it right to the end of the day, the expected move is 70 points. Dan, what does that mean? This is about 60 to 70 points is the expected move to Wednesday. And this is a week where Tuesday we have, I think, the CPI. So you have some news coming out. But what does that mean? It's just a standard deviation. It's saying there's about a 68% probability that will be between plus 60 or 70 points up, plus 60 or 70 down. So when you look at our short strikes, there's a good probability we're not going to move that far past a short strike. So by going far out of the money, the tent is wide enough to handle the price move. So this is just a little introduction into the world of double diagonals. I think they're a wonderful strategy. I've been doing this Monday 11-day double diagonal, just like we've talked about for a year or two, and it works wonderful. It works pretty good. And now with the automation, I'm adding, you can put different double diagonals or double calendars on different days, so you can have a schedule of trades to go on. And so this was just an example of, and that was the first double diagonal that I automated on option Omega, which was Friday, this exact trade here. So let's go to the last piece of the puzzle. So here's my trades that would go automated. And these are the trades I have to go automated during the week. And this is the double diagonal. And so you can see here, and we'll go through this. These are some of the parameters I have. Open trades at 3:00 p.m. Eastern every Friday. So it's scheduled to go, right? If I'm talking to a neighbor, going in a mailbox, boom, this will go in. Unless I don't want it to, right? I mean, you still have control over it. Use exact days till expiration, exact strike offsets, allocate 10% of portfolio. I have a profit target on this, on the back test, 100%. Exit trades at 2:25 p.m. At the latest on that Wednesday. Exit when the short-long ratio is below 0.05. And that's just, when you get let me just talk a little bit about the short long ratio. Going back to the screen here, when you go further out, like at 20 delta put or call to sell your wings, you go further out of the money, sometimes it could get a sag, especially as you get close to expiration. When you're putting these trades on, a sag in the middle. So that short long ratio helps. It's a good risk management tool. If volatility especially starts going down or there's not enough premium left in it, it gets you out. So that's a good risk management tool. Now, there's other good risk management tools, and that's what I like. That's why I get excited about the Option Omega tool, because I think they have very good, since I'm a risk manager, very good risk management stuff. And the other thing, exit using leg deltas, and I'm going to show you that, but it just means that, where do double diagonals, double calendars, where do they start getting in trouble? You can see here's the graph today, here's the graph at expiration, and when you start going beyond the short strike, that's when things can get a little dicey, especially early in the trade. So a good feature that Option Omega has is this exit when using leg deltas. And I'm going to show you that in a second. Some of these miscellaneous stuff are just to make it very realistic. 10-cent slippage. If it says you're up X amount of dollars, you got to have 2 hits at that because you can get false readings. We have opening fees, commission fees to put in. So very realistic. And if you look at this, just going through it, this test, if you look at some of the main things for this, lot of trades, 150, 52 trades, 104 winners, 68.4%. This is from May 2022 to August 2025, which is important. Good win percentage, maximum drawdown. Here's a MAR ratio, starting capital, ending capital. So you just want to make sure, pretty good and steady here most of the time. Average loser, average winner, max winner, max loser. So, and you're constantly trying to make it better, but that's the test. And you can see in this one, we had allocate 10% of portfolio. So if you look at some of these trades here, this one was a loser. Then you had quite a bit of winners here. But give an example with now this is about a $20,000 trade. Again, you can see the difference between the calls here. Strikes are 10. So $1,000 plus the debit, this would be about $2,400. 1,000 plus this would be $2,700. 1,000 plus this would be $1,800. So, around 2,000 to 2,500 is the trade. This was 11 contracts. So you're talking about, this would be about a $22,000, $24,000 trade. Give you the opening price of SPX, the premium you paid, closing price. So this trade lost 3,900, and then you had a 1,900 winner, 5,000 winner, 10,000 winner, because we had the profit target at 100%, right? And the reason for close, you have here below delta, and I'm going to show you that. And that's why, these are great risk management things. And let me show you, let's go back up. If you look at this, I'll just show you this real quick. If you look at this trade, if I scroll down here, these are awesome risk management things. I mean, this is how I'm thinking when I'm managing a trade. So it's saying, look at Dan sold a 25 delta put. When that 25 delta put on the downside gets to about 65, as Roberto Duran said to Sugar Ray Leonard, no mas, I'm done, right? If the 20 delta call goes to 65, right? You're going to get short deltas on the on your call, short deltas on the whip and the put. You're going to get long deltas. Get out. So basically, what it's saying is, Dan, where you're going to get in trouble on these is when you go through the short strike and when the deltas explode. And that's when we're going to protect you. Keep the losses under control so your drawdowns, you're not just getting hammered. And so I think that's absolutely crucial. So in this, if you said to me, Dan, you're a risk manager, what are the two big risk management things here? The delta leg, right? That's where you get in trouble. You go through the short strike and your shorts get in the money. This nails it between the eyeballs, right? And the short long ratio helps when there's no more premium left. So I've got very strong risk management tools in here. And that's it. I hope that gave you a good feel for it. And then I've got this thing just as I'm showing you here, right? If I go to trade live and you look here, this thing is, let me just scroll here, second strategies. But here's this one, 5-7 DC, double diagonal 5-7. And right now it's active. It's locked and loaded. Paused? No. Right? That means it's ready to go this Friday, locked and loaded. 3 contracts of that at the brokerage. Now, what if I say, you know what? For whatever reason, right? My toes are twinkling, or the Cubs are losing, or whatever reason. If I want to pause the opening trade Friday morning, right? You know, President Trump's going to wrestle President Putin for control of the world. You know what? Maybe I don't want to have a type of a range bound, even though it's a wide range. I'm going to pause the opening trade. Or what if it's not working anymore? I could deactivate it. It gives you quite a bit of leeway there. Does that make sense? So I like it. They're going to get on. They're not going to get distracted as I am. So, anyways, thanks for listening. Have a wonderful, wonderful day, and we'll talk to you later. Thanks.